everyone. Welcome back to the Daily Dive. Today we're chatting with Rick Rule from Sprott US Global Holdings. Hey Rick, welcome to the dive.
It's a pleasure to be on with you. Thank you for having me.
So it feels like gold juniors are starting to catch a bid again. What sense do you get that things are picking up?
Well, I think what you say is very accurate. Certainly the volumes are picking up. What we saw really isn't so much, how would I say it? I think the gold juniors got ahead of themselves last summer. In every prior bull market I have ever seen, market leadership went from the best of the best sequentially down the valuation metrics. In this particular market, I would say that market leadership went right straight from the best of the best, the Francos and the Agnicos of the world, all the way down to the juniors. And I think the juniors really collapsed of their own weight. They got ahead of themselves. And of course, the Canadian dealer network kicked out so many financings that the demand was just swamped in paper. Now we've begun to work our way through that. As you suggest, I think the junior sector is beginning now to pick up the pace again.
Do you think a new U.S. stimulus package is already baked into the market?
I don't. I think that the market thus far has been narrative oriented rather than arithmetically oriented. If you look at debt and deficits in the United States, even in a historic sense, I don't believe that they are factored in the market. And I don't think that a bipartisan consensus in Congress around additional spending has been figured into the market. Simple arithmetic, and I'll take you through it, not in Canada, but in the United States, is fairly daunting. We have about $26 trillion, 19 trillion net in on-balance sheet liabilities at the federal level, and something in excess of $120 trillion, that's 12 zeros, Cassandra, in off-balance sheet liabilities, which is to say entitlements. So the aggregate debt at the federal level before state and local debt handily exceeds $140 trillion. And we propose to service this with the national income, taxes and fees less expenditures. The problem is that the national income is about $3 trillion annually upside down, which is to say, rather than service the debt, we add to it. It's difficult. Admittedly, I'm old enough that I don't do new math, but it's difficult to understand how you add a column of negative numbers and arrive at a positive sum. So even before we worry about the stimulus package, I don't think that the arithmetic of gold takes into account the hole that the United States and also Canada has already dug for itself.
How do you think social media in 2021 changes the way companies need to tell their stories?
I would argue, and I'm a little out of my depth here, but I would argue that social media has changed a lot of things. I would argue that the distribution of the narrative via social media is largely responsible for the incredible upsurge in popularity that the junior sector enjoyed in the middle part of the last year. It's interesting. At Sprott, we worried for 5 or 6 years about how we might reach millennials as a firm. As you look at me, you can see I'm sort of 3 millennials wrapped in one old bald carcass. In truth, by utilizing social media to deliver our market, we didn't have to reach millennials. They reached us. The idea that you can have a peer-to-peer discussion, which is to say a bottoms-up discussion around a sector, is, I think, a wonderful circumstance. Information in the sector has always been distributed on a top-down basis, which is to say by brokerage firms or by other reasons. Now, there's going to be lots and lots and lots of mistakes in peer-to-peer distribution. But the truth is that the democratization of paradigm and the democratization of information is always a good thing. So I would suggest, at the risk of sounding alarmist, that social media changes everything. And over time, as people develop discipline, changes everything for the better.
What advice do you have for young people in either Canada or the US who are starting out with not much capital and are watching asset prices rise further and further out of reach?
Probably 3 pieces of advice. The first is to invest in yourself, invest in your knowledge, invest in your skill sets, If you're an employee, make yourself an indispensable, better employee, which is to say, increase your earnings potential. You can't control the aggregate levels of pricing. The second is to understand that prices are extraordinarily variable. And if you save, it's important to save at every point in time in your life. If you save, believe me, the market will deliver the opportunity. Markets are volatile, if nothing else. I know the mantra in Canada now is that real estate prices never fall. I remember 1982 when the average home price in Vancouver fell by 50%. Whether or not you think that's a good thing or a bad thing probably depends on whether you are a homeowner. But I would say invest in yourself, which is to say increase your utility to society, which will increase your income at the same time that you save and invest prudently. And then the third piece of advice is simply to be patient. About once a decade, whether you like it or not, the market seems to deliver extraordinary buying opportunities, which may or may not be inconvenient for you, depending on whether you've paid attention to my first two pieces of advice.
Our audience is primarily the retail investor, the butcher, the baker, the candlestick maker. What advice do you have for avoiding the pitfalls of investing in junior mining?
The first is common sense. If something seems too good to be true, it almost invariably is. Pay less attention to narrative and pay less attention to price. It's interesting that when we have discussions about stocks, that the discussion always involves price. Information about price is irrelevant if you don't have an opinion about value. Money is made on the delta between price and value, which is to say, if you think something's worth $1 and it's selling for 50 cents, you should buy some. If the price is $1 and you have no idea what it's worth, why would you bother caring that the price was $1? It makes absolutely no sense. There's more information available today than ever before. EDGAR, CEDAR, filing statements, 43101s, read them. It's important, too, not to own too many stocks. You know that I rank investors' portfolios from around the world on a daily basis. And so often, investors will send me a portfolio with 30 or 40 stocks. They can't possibly follow 30 or 40 stocks if they have a life. I would argue that investors, irrespective of age, if they're employed full time outside investing, need to limit the number of stocks in their portfolio to the number of hours per month that they plan to spend studying the stocks that they own. Yeah, I'll leave it there. Too many people, not just young people, not just retail people, but even institutional investors have this very odd thesis, this investment technique that goes, quote, got a hunch, bet a bunch. And it doesn't work.
What overall impact do you think Robinhood traders and social media groups like Wall Street Bets are having on the overall markets?
I think at the margins, they're having a very large impact. The Robinhood buyer is, of course, the marginal buyer. Uh, he or she are the ones that drive popular narratives to insane extremes on the upside and on the downside. This liquidity is a very good thing for the market. Uh, and in truth, every generation has to learn their lessons the hard way, which your generation will do. But particularly with regards to microcap stocks, the importance in the near term of the Robinhood buyer, if that's the right phrase, is extraordinary. The millennials are unique as an investment generation in two ways. The first of all is that they are the first to have both the benefit and the curse of peer to peer information, which is to say, social media. The second is, and I'm making this up just from my own observation, uh, the millennials are the most narrative obsessed generation that I have ever seen as investors. That's fine as long as the narrative is working for you, but decidedly less pleasant when the narrative gets ahead of itself and collapses of its own weight. Now, the truth is that over time, because of the millennials' access to information and their access to peer to peer as opposed to top down distributed information, my suspicion is that the millennials will ultimately emerge as the best investing generation that I have seen. But I think they're going to have to pay some cover charges in the next 4 or 5 years. They're going to need to learn how to do it first.
So, do you see any likelihood of CPI ramping up over the next few years? How do you think the Fed reacts if inflation does start to creep up?
I think that there are two forces at work. One inflationary, which is to say debt deficits and the debasement of the currency through quantitative easing, and the other deflationary, which is to say what's left of global free trade, which makes everyone richer and makes price rise, makes costs lower, and technology, which is by itself deflationary. I don't know. Oh, one more, of course. The possibility of default. Understand that our social debts, which is to say the debts that we allegedly owe each other, by the way, we don't owe them to each other. The spenders owe them to the savers. Um, but the weight of that debt is in and of itself deflationary. The way that we have tried to avoid the consequence of the debt, which is to say debasing the currency, is inflationary. If I had to bet one way or another, I would say that CPI rises 3 or 4 or 5 years ago. I would urge your listeners too to consider whether or not CPI is the most even a useful gauge of inflation in a factoid sense, which is to say it's the predominant measure of inflation. It's the one that matters the most in the near term. But I'm not sure that it's accurate. As an example, CPI inflation doesn't cover tax. Now, I guess if I didn't have to pay tax, I wouldn't complain so much about the index. But the idea that my cost of living is measured without an impact to tax feels to me to be relatively silly. Also note that it's consumer prices that it measures. It doesn't measure asset prices, except for lodging, which it measures on a quote, hedonistically adjusted basis, which is to say, if you're living in a nicer house than your parents did, but you're paying less, they adjust the component down as opposed to up. Seems a bit fancy for me. I think if you add back debt and deficits, which is to say the part of inflation that I don't have to pay because I'm going to be dead, but you have to pay because I left you the bill, and you add back tax and you add back asset inflation, which is to say real estate inflation and equities inflation, that the true rate of inflation is substantially higher than is stated by the CPI rate of inflation. I don't know about you, Cassandra, but when I look at the basket of goods and services, or rather, when I look at the escalations that they're talking about in consumer price indexes, those people must shop at a different place than I shop. The idea that my cost of living in the United States, and I'm an old cheapskate, I don't buy much. The idea that my cost of living is escalating at 1.6% annually compounded seems silly to me.
Overall, what commodities are you the most bullish on?
In the near term, precious metals. By the near term, I mean the next 18 months. On a risk to reward basis. When I look at quantitative easing, which by the way, Cassandra, if you did it would be called counterfeiting. When I look at debt and deficits, when I look at negative real interest rates, and when I look at the fact that precious metals and precious metals related assets, market share as a percentage of total savings and investment assets in North America are at 3-decade lows, which is to say that gold is under-owned, despite the fact that wind is in precious metal sales. I think that the easiest trade in the space, the most probable trade in the space in the next 18 months is probably precious metals. But beyond that, I think any commodity that you have that is necessary for the way that you and I live over the next 5 or 6 years, that's priced at a discount on a global basis to the cost of production, must go up. Do any of those commodities have names? Well, it just so happens that they do. Oil and gas are profoundly cheap, Greta Thunberg's preference notwithstanding. Uranium is profoundly cheap. The big thinkers' wish list notwithstanding. Even the big thinkers, when they walk in a room and hit the toggle switch, want the lights to come on. So those would be two examples. In a Canadian context, potash, priced at a substantial discount to the total cost of production worldwide. Is there ongoing demand for it? I don't know. Are people going to want to eat in 5 years or 6 years? I reckon.
So, Rick, final question here. If investors wanted to invest with Sprott Holdings, how would they go about it?
The easiest way is for your subscribers and listeners to go to a website, sprottusa.com/rankings. There, you can enter all the natural resource stocks in your portfolio, and I personally will rank them on a no obligations basis, 1 through 10. I will also comment personally on those issues where I think my comments might have value. And I will include, too, if you ask for charts, the 50-year Barron's Gold Mining Index chart, which is the broadest base, longest running gold equities index available, and a 100-year commodities chart that will show just how cheap commodities are relative to asset classes on a valuation matrix going back 100 years. That's sprottusa.com/rankings.
Wow, that's great, Rick. Thank you so much. And thank you for joining us on the show today.
A pleasure. Thank you.
And for our viewers at home, don't forget to click that subscribe bell below. We'll see you next time on The Dive to talk all things small caps.